Welcome to County Portal, your simple source for local government services and public records. Let's get started.
Figuring out your federal tax classification can feel confusing, but it's essential for filing your taxes correctly and making sure you don't overpay the IRS. Your classification, whether for you as an individual or for your business, determines your tax rates, the standard deduction you can take, and the forms you need to use. Let's break down how you can find yours. First, for individuals, your tax classification is called your filing status. There are 5 main options, and your status is determined by your personal situation on the very last day of the tax year, December 31st. If you're not married, your 2 main choices are single or head of household. You're considered single if you're unmarried, divorced, or legally separated. You might qualify for the more favorable head of household status if you are unmarried, pay for more than half of the household expenses, and have a qualifying child or dependent living with you. This status usually gives you a lower tax rate and a higher standard deduction than single. If you are married, you can choose to file as married filing jointly or married filing separately. The vast majority of married couples file jointly because it typically offers more tax benefits and a lower overall tax bill. The final status is qualifying widow or widower, which you may be able to use for 2 years after your spouse's death if you have a dependent child and meet other specific criteria. The easiest way to confirm your filing status is to look at the top of last year's Form 1040 tax return. Now, for businesses, your tax classification depends entirely on your legal structure. If you're a one-person business and haven't legally formed an entity like an LLC or corporation, you are a sole proprietorship by default. The IRS sees you and your business as the same entity, and you'll report your business income on a Schedule C attached to your personal tax return. If you're in business with at least one other person and haven't formed a legal entity, you're a partnership. The partnership itself files an information return, but the profits and losses are passed through to the partners to report on their personal returns. If you have formally incorporated, you are either a C corporation or an S corporation. A C corporation is the default structure where the business is taxed on its profits, and then shareholders are taxed again on any dividends they receive. An S corporation, or S-corp, avoids this double taxation by passing income directly to the shareholders, similar to a partnership. You must specifically file Form 2553 with the IRS to elect S-corp status. A common point of confusion is the LLC, or Limited Liability Company. An LLC is a legal structure created by state law, not a federal tax classification. The IRS allows an LLC to choose how it's taxed. By default, a single-member LLC is taxed like a sole proprietorship, and a multi-member LLC is taxed like a partnership. However, any LLC can file paperwork to elect to be taxed as either a C-corp or an S-corporation. To find your business's official tax classification, you should review your business formation documents, your EIN application letter from the IRS, Form SS4, or any election forms you've filed. Knowing your classification is the critical first step to a smooth tax season because it's the foundation of your entire tax return. Thanks so much for watching. We hope this helped clear things up. If you found this video useful, please give it a thumbs up and subscribe to our channel for more simple explanations of complex